So OPEC Plus is winning the battle, and this is bad news for the global economy, especially the West. The world still runs on oil, and as prices stay high, many economies without cheap energy are going to suffer. The UK has officially entered a recession. The data has confirmed a contraction in the British economy. The third biggest economy in the world, Germany, is about to fall into one as well. On Thursday, the Bundesbank admitted that the German economy has been in recession since Q1, and the recovery for the Germans is going to drag further and further into the future. What Saudi Arabia and Russia just did goes beyond protecting their economies. Raising the price of oil increased their revenues, but it also triggered a seismic earthquake. It exposed countries with fragile supply chains and poor access to abundant energy. And this pain is only going to continue. The OPEC Plus cuts are starting to tighten the oil market. The calls for an oversupply of oil are starting to flip, it's starting to reverse. We could be back in a supply deficit. Global imports and exports are dropping, which should correlate to decreased oil demand. But despite this, the oil price is still rallying higher and higher. Since December 2023, the price of oil has been climbing up. It has gone from $73 a barrel to 87. That's a crazy rise of 20% when economies are slipping into recession. Exports from big manufacturers like China and Japan, they are contracting. Chinese exports in 2023 fell by over 5% because global demand is dropping. In Japan, factory orders are still collapsing. Manufacturing activity in Japan, the PMI, is falling. It's on a one-way trip to economic hell. Activity has fallen again to 47.2 in February. PMI is a leading indicator, and anything below 50 represents a contraction. This is a big problem because during this same period, the Japanese yen has been collapsing, and you'll quickly understand why this is such a big problem. We are still in a demand crisis. From the start of 2022, the value of the yen has been crashing. It has fallen by over 20% to the dollar, and this makes Japanese goods 20% cheaper to import. So if you're a foreigner, a holiday in Tokyo is a big bargain. Buying stuff made in Japan is much cheaper as well. The very fact that orders in Japan are still collapsing shows us the state of the global economy. Consumption in the biggest economies, especially Europe, is weakening. The longer energy prices stays elevated, a strong recovery will be hard. Only countries with access to cheap energy like China and India can really enjoy a strong positive growth. Let's recap how much oil has been taken off the market from OPEC. Russia, Saudi Arabia, and the oil producers, they have taken away a total of 5.9 million barrels a day. That's equivalent to 5.7% of the world's daily demand, and this shows us how inelastic oil demand is. If a 5 to 6% supply cut can trigger a 20% rise in price, it shows us how dependent we still are on fossil fuels. OPEC is clearly in the driver's seat here. There are many analysts now predicting oil to shoot up to $100 a barrel, and you quickly see that this is entirely possible. The OPEC cuts are starting to push the oil markets from a surplus to a deficit, and this means there are not enough oil volumes versus what the demand is, even at these weaker levels. Before the cuts, the oil markets was expected to enter a surplus of over 1 million barrels a day. That's the black bars in the chart. However, after OPEC extended their cuts, the situation has completely flipped. The blue bar shows us the estimates after the extension of the production cuts in early March. The market now expects a deficit of 300,000 barrels a day on average, and this is going to validate OPEC Plus even further. If you're MBS or you're Putin and you see this big flip, you'll be emboldened to extend the oil cuts even further, perhaps all the way till December. And this is a very likely scenario. If we examine the motivations of Russia and Saudi Arabia, both countries have no choice but to keep the price of oil high. And this is especially true for the Saudis. MBS needs to transition Riyadh away from fossil fuels. To make the leap, he needs a ton of money. The kingdom is forecasting a budget deficit of 79 billion rials in 2024, and that's around $23 billion. And this means they have to borrow 23 billion from investors to hit their spending goals. But that amount could easily double at the rate MBS is spending. This isn't ideal today when interest rates are at record highs. Back in January, Saudi Arabia sold $12 billion worth of bonds to finance their spending. These are bonds issued at different maturities, including 6, 10, and 30 years, and their yields were 4.9%, 5.1%, and almost 6%. Compare that to a 10-year treasury bond that yields only 4%. You can understand why borrowing money isn't a good idea for the Saudis. Why borrow money when I can cut oil production and increase my revenues directly? the Saudis have tremendous influence within OPEC to push for further production cuts. The Saudis need oil to go above $90 a barrel or maybe even 100 at the very least to balance the budget, so they'll likely push for further cuts come June. Russia also needs the price of oil to rise. While revenues are still flowing strong for Putin, the sanctions have impacted the final selling price of oil. It's forcing Moscow to sell oil at a discount to compensate buyers for the added risk. Estimates have put the impact of sanctions between 5 to 7% of the oil price. Shipping companies charge this additional margin to transport Russian oil. While that isn't a huge hit, it still eats away at the full potential of their oil revenues. Because of Ukrainian attacks on Russian refineries, this is also causing Moscow to lose some revenues for fuel exports. Russia's refinery runs could fall to 5.1 million barrels a day, and that will reduce the exports of diesel and gasoline to the world. So it is in Russia's interest to push the price of crude higher as well, at least until their refineries are repaired and back online. So you can see the amount of supply side risk building up around the world because of the drone strikes. Their consequences for every action and high inflation might be coming really soon. According to JP Morgan, Brent might hit $100 a barrel if Russia follows through with their cut. If Moscow shifts away from the export cut to a full production cut, that will affect the supply and demand equation in a very big way. It might be enough to push crude prices much higher to triple digits. It's without a doubt that higher oil prices affects every country in the world. Even the US, a major oil producer, is suffering as well. The cost of living there is going higher. Gasoline prices in the US are starting to rebound. By the end of summer, the price is expected to hit $4 per gallon. That's another 15% increase at a minimum. And this isn't good news for inflation and the CPI figures. Higher energy prices trickles down to everything. We know this. It pushes the cost of goods and services up. It complicates the Federal Reserve's inflation fight, and it makes Biden's campaign that much harder to win. While it's true that US oil production is the biggest in the world, there are limits to this. American production isn't enough to fight against OPEC when the whole world is still on fire. We have geopolitical risk getting worse every day. The Russia-Ukraine war is one obvious flashpoint, not forgetting the chaos in the Middle East. Despite the UN ceasefire resolution, Israel is still going into Rafah. Does that stabilize the Persian Gulf or destabilize it? Geopolitical risks are supporting the price of oil higher. It's causing traders to bid up the price and secure supply because anything could go wrong. Another big problem is US production doing a big U-turn. American output fell by 6% in January due to severe cold from a winter storm. Crude oil production in Texas fell by 5% down to 5.4 million barrels a day. Production in North Dakota dropped by nearly 13% as well. And this is flipping the equation from an overall global surplus of oil to a supply deficit, and that is horrible. Over a longer time horizon, US production is expected to peak out soon. US shale production will continue to grow, but not at a crazy rate over the last 2 years. Power is going to shift back towards Saudi Arabia and Russia. It's important we look at the trajectory of US shale oil. Since 2014, the percentage of production from new wells has been declining. It went from 63% of production down to 43%, which is a concern. And this tells us that older wells now form the majority of US shale production despite urgent exploration. Shale oil isn't your traditional reserve in the ground. It costs a lot to extract energy out and the reserves decline rapidly early in life. US production is surging because prices are very high and the incentive to pump more is there, but it will run into a brick wall over the next few years. Producers will have to keep drilling to find new wells, but the output from these new wells are drying up fast. It starts as a huge gush of oil, but quickly declines to a trickle. Each well requires you to work harder to extract the same amount of oil. It's like a treadmill that keeps speeding up every few minutes. You use more effort to run, but at the end of the day, you're still stuck at the same place. And if that isn't enough, the US just hit the final nail in the coffin. They have confirmed that oil prices are out of control and OPEC still has tremendous influence. Biden is about to refill America's strategic petroleum reserves to prior levels by the end of the year. The US Department of Energy will buy 40 million barrels of oil this year alone to refill the SPR. 40 million barrels a day isn't a lot, but the psychology behind it is enough to push prices higher. The remaining 140 million barrels in the SPR won't flood the markets either. The US government is back as a net buyer of oil. Energy security is clearly now an issue for the elections. Biden's buying is going to support the oil markets even higher. And we must, of course, talk about Europe as well. When it comes to higher oil prices, the biggest winners are the producers. Russia, Saudi Arabia, and even the US benefits the most, and by definition, the rest of the world loses because they have to pay more. Inflation goes up for everyone in varying degrees. However, the biggest loser hands down is Europe once again. Europe's top economies continue to contract in March. The German and French PMIs are still deep below 50 in the contraction zone. Europe has an inflation crisis which will get worse as oil prices continue to rise. Europe doesn't have direct access to cheap energy. Unlike other importers like China and India, Europe is effectively decoupled from Russian energy, at least the bulk of it, so their imports from the US and the Middle East will cost more, according to the Hamburg Commercial Bank. If you were hoping for a recovery in the manufacturing sector in the first quarter, it's time to throw in the towel. This weakness is only going to continue because the cost of industry is simply too high. And this is how important cheap energy is for any economy centered around manufacturing. Countries like China, however, will suffer less because they have still access to cheap Russian energy. They can win the price war against Europe rather easily. In January and February, exports from China rose by 7.1% in US dollar terms. And these are exports to other countries and not domestic consumption. There is a clear distinction here. Despite the decoupling narrative, countries are buying more from China because prices are still competitive. This increased the trade surplus to a record $125 billion, making the country wealthier. The importance of cheap energy cannot be overstated. As prices continue to go higher, this weakens the Eurozone economies even further. The French central bank is starting to panic. They are urging the ECB to cut interest rates before an economic collapse happens. Higher rates are making it hard for companies to grow. He wants the cuts to come in as early as April next month. The ECB should front-run the Federal Reserve to slash rates down to ease monetary policy. However, the production cuts from OPEC are making that quite impossible. The underlying issue for Europe is still an inflation crisis, and the majority of central bankers there, they know that. Looking at the ECB Governing Council, it's clear that the bank is still very hawkish. The key players, Christine Lagarde and Nagel, are still very much hawkish. The ECB president and head of the German central bank still supports high interest rates because the inflation risks aren't over yet. Higher inflation could be worse than higher rates. The cost of production goes up and people's buying power collapses, so handling that crisis is more important than stimulating growth. There's no growth to stimulate when global demand is suffering under high inflation. So we are in a weird state of affairs today. OPEC doesn't just influence the global price of oil, they are affecting the monetary policy of global central banks. And this is especially true in the Eurozone. If rate cuts are to come, oil prices first must stabilize down. A big hope is for Venezuelan oil to flood the market. Can this rebalance the supply and demand crisis? Will this save the day? In October last year, the US lifted oil sanctions on Venezuelan production, and this allowed oil volumes to slowly inch up. It's a modest recovery of 60,000 barrels a day of increased production. Now the hope is for volumes to hit back up to the pre-sanction levels of 2019, back to 1.5 million barrels a day. But that hope is about to collapse, and it's because US sanctions are coming back. Biden has told Maduro that the exemption will expire on April the 18th, and there's no renewal coming. Because of election troubles, the exemption is going to lapse and sanctions could be slapped back on Venezuela very soon. Obviously, this won't be good for countries importing oil. Global volumes will be curtailed again. US sanctions will force many countries in the world to compete in the existing market for a limited amount of barrels. India, for example, is halting their exports of Venezuelan crude. Because of the risk, Indian refiners are moving away from these imports. Oil from Maduro costs only $60 a barrel imported into India. Even Russian oil is nearly $79 a barrel with the discounts. By removing Venezuelan oil from the picture, India will have to buy more crude elsewhere, and that demand will drive prices even higher. So the global energy picture doesn't look good. OPEC is back in full control. We can expect further production cuts to last all the way till December, or maybe this could even drag well into 2025 as well. But let me know what you think. Will OPEC cut even further, and will this push the world economy into a recession? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.